Hello, and today we are looking at NEE, NextEra Energy. We're going to run through some key data. We're going to take a look at the dividend safety, run through some really important metrics, and we're going to end the episode, as always, with our stock valuation model, running through our 4 valuations, get to our intrinsic value, and finding out the acceptable buy price using our margin of safety. Now, one thing to note, the stock is down just under 12% year to date, and there is a trend currently with energy stocks that have taken a bit of a hammering, probably due to the fact that money is being moved into tech currently, as we have seen lately with the AI booms such as Nvidia and the others. Now, if you've been holding this for the last 10 years, you'll be having share price appreciation of 291%, excluding dividends, so that is quite positive if you ask me. Now, if we take a look at the yield, we can see a 2.53%, which isn't too bad, and if we look at the range, it is currently heading towards that 52-week low of $69. Now we're going to jump straight into the dividend safety, and it currently has a score of 99, which is incredibly safe, market cap of 150 billion, and let's take a deep dive into these other numbers. Now, some key metrics here, a few things just to point out. In the last recession, 07 to 09, the dividend was increased, and the recession, although there were sales of negative 9%, this was above the average growth during the recession, and as we can see here, it still beat the S&P 500 from the last recession. However, it was still negative 31 as opposed to negative 55. We will take a look at these others now. Now, dividend growth, as always, I love to see 4% plus. 4% has been the US inflation rate over the last 30 to 40 years. So if you're not getting at least a 4% increase in whatever it is, dividend, salary, and so on, then you are losing purchasing power. Last increase a few months ago at 10%, very, very nice as a dividend growth investor. And over the last 20 years, that dividend CAGR of 9%, again, in my opinion, very positive. 27 years of consecutive increases, making it a dividend aristocrat. Dividend aristocrats are companies that have consecutively increased their dividend over the last 25 years. So, positive so far. Dividend yield theory states that a company is undervalued if the dividend yield is above the 5-year average, which we can see here, currently 2.53%, 5-year average at 2.15%. So, this shows that they could be undervalued. As always, we never look at one theory in isolation or one valuation. Forward PE trading below the 5-year average of 28, which is positive to see in terms of undervaluation, currently sitting at 23.5. And we can see here the sector PE, it's above the utilities PE of 16.3. And as mentioned, the 52-week price range is towards that 52-week low of $69. Now, earnings payout ratio and free cash flow payout ratio. One thing to note moving forwards today is that we will not really be looking too much at the free cash flow, given utilities earnings payout ratio is much more meaningful. The reason behind this is we will see that the free cash flow tends to be negative due to capital intensive investments and long payback periods. They essentially issue debt and equity to cover the funding's gap. So, looking solely at the earnings payout, I personally like to see below 60%, as this means that there is room to grow that double-digit dividend. And for the large part, we can see it has been below 60%. So for me, that's really positive to see. Again, we'll ignore the free cash flow. However, I have put this up here just for educational purposes so people are aware. Earnings per share 2013, $1.24. Earnings per share 2022, $2.90. Now, what I like about this, not only has it grown from 2013 to 2022, but what we can also see is that it has continued to grow as the years have gone on. Some graphs that we see, it goes up and then it goes a sharp decline and then it goes up. So it looks like when you compare 2013 to 2022 that it's performed well. But you also have to consider what has happened in between. And for me, this is a very positive upwards trending graph, and long may it continue. Sales growth, we like to see 3 to 7% at a minimum, and for the large part, this company has done that. However, there have been some years, 2016, 18, 20, and 21, where they have seen negative growth, and that shows in the below graph As we can see, it's not that upwards trend that we like to see. It is slightly staggered. However, 2013, 15 million, 2022, 21 million. I think if you were to take the next 10 years and have that same increase, then I think that would be positive. However, one just to note moving forwards. Shares outstanding. Now, typically we like to see a declining graph. However, with utilities, they normally rely on issuing equity to fund portions of their growth expenditures, so this is fairly common to see. Return on invested capital. Now, I like to see around 10% is my golden dividend metric. For utilities, you could get away with 7.5%. However, this has been one area where NEE has been lacking, and it has taken a decline from 2013 to the current year. So in my opinion, one to keep an eye on, but preferably we would like to see a higher number, heading more towards 7.5% at a minimum. Again, operating margin above 18% for utilities, and they have met that over the last 2 years, and before that it has been considerably higher. So I would say fairly positive. Again, something else to consider, as we don't want this to be going below that level. Again, free cash flow margin, educational purposes only. However, as mentioned before, it will be negative. Net debt to earnings before interest, tax, depreciation and amortization below 5.5 for utilities. Again, what this means is if we take 2022, it would take NEE 7.43 years to pay off all their debt net of cash on hand. Personally, this is slightly worrying, but given that they have for the large part of the last 10 years had it below that 5.5, something just to look forward to when you look at their earnings next quarter and next year. Net capital, nothing really to say here. It should be around below 0.6 for utilities. Again, they have been, so that's fine. Essentially, 2022, 57% of their company's financing was from debt rather than equity. So again, not too bad. Overall, I don't think it's too bad. Nothing really stood out as anything really negative. However, now let's move on to the valuation, and let's jump straight into Graham's valuation model. Again, do check my Graham's valuation model video if you want to see how to create this. Effectively, we put the earnings per share $3.37, and we put the growth rate based on Wall Street analyst estimates at 9, and we input the current yield on AAA corporate bonds, which seems to be increasing day by day. Now, this gives an intrinsic value of $50.80, just to show you that is significantly below the current trading price and below that 52-week range. We then move on to the multiples model, where effectively we input companies in a similar sector and similar business size. We have Emeren, Southern, Duke Energy and Sempra Energy. We put the stock price in, the earnings per share, and this gives the PE multiples. Then we get the average PE, 18.96 multiplied by the earnings per share, and this gives a multiples valuation model of $63.89. Again, below the current trading price. Then we move on to the dividend discount model, which is a very good model for NEE, given we can see here when we put their yearly dividends in, their growth rate has been quite high, and we get an average growth rate of 11%. Effectively, what we're doing here is we're getting the value of the next year dividend and having that over the cost of equity less the growth rate. Now, the growth rate, I've gone for a bit more conservative than the last 5 years, just because I like to be a bit more on the conservative side when looking at these valuation models. However, you could get away with doing a slightly higher growth rate. This gives a DDM price of $133.39. Again, this has a lot more upside based on this model, and that's why we use more than one model, as we don't like to look at these things in isolation. We then come to our final model, the discounted cash flow model. We input our free cash flows, we get the growth rates year on year, and this shows an average growth rate of 31.6% year on year. Now, we've gone with 26% just to be, again, on the more conservative side, looking over the last 10 years. However, I do believe that moving forwards, this will actually be higher, but I prefer to do more conservative estimates. Now, for the future free cash flows, we've started off in 2019, just for the fact that 2020 was negative, and as we can see, for the last 10 years, it has been around that 2 million area. So just wanted to make that clear. We then use once we've used the growth rate, we then use the discount rate to get the present value of these future free cash flows, and this gets to the sum of FCF here. Add the cash and cash equivalents, subtract the total debt, and we arrive at our equity value. We divide this by the shares outstanding to get a DCF price of $82.43. So, as always, we've run through our four models as we've just gone through, and these are the values. Our intrinsic value is effectively the average of these four. As always, smash the like button, smash the subscribe button if you're enjoying the content, as it really helps me keeping the channel going. This gives us the intrinsic value of $82.63. Again, we've got the current price here, and typically I like to see around 10% of a margin of safety. With utilities it could be slightly more, however it's personal preference. For those that are looking at a 10% margin of safety, you'd be looking at an acceptable buy price of $74, so currently this would be in the buy zone. If you were looking for a lot more, you'd be looking at around a 20% margin of safety, coming in an acceptable buy price of $66.10. This is effectively slightly below that 52-week range. However, my thoughts are, given the fact that a lot of money is being moved into tech stocks, we could see this come further down, so just one to note. And finally, we're going to end on Wall Street price forecast for the next 12 months of $89.27. So analysts do expect upside to the current share price. As always, smash the like button, smash the subscribe button if you've enjoyed the content, and let me know your thoughts below. And as always, have a lovely day.